minute. Yeah, that suggests just on the face of it, there's a further 20% downside risk in the price of CSL. Now, of course, we never know when that's going to happen, but that's what the facts are telling us. So I think that's something to very much bear in mind. I thought we might just talk about the overall market now. Uncertainty, hot air's come out of the market over the last little while, which I think, quite frankly, is never such a bad thing. When you look at the overall stock market at the moment, again, so slide number 5 here, when you look at the long-term PE of the Aussie market, round about 14 times, with the hot air having come out of the market over the last little while, it's trading as fair value, as the heading suggests there. So it's not cheap and it's not expensive. However, within that are two distinct groups of stocks, these still overpriced growth momentum stocks and value stocks where we think there's a lot of opportunity there. And we'll talk a little bit more about that in a few minutes' time as well. But just continuing the theme of the overall market value, when you look at the market on a yield basis, still looks, you might almost say, compelling in many ways. Tax effective yield there, and this is for the overall market, of course, of about 6%. That's the blue line. Term deposits there, as we all know, the grey line there, not delivering an awful lot and unlikely to change anytime soon. Which then brings me to corporate balance sheets, and this is something that we've been talking about for quite a period of time. One of the really big pluses of the Australian stock market, and this has been a case for a number of years now, is the strength of corporate balance sheets. And so what this is as a measure of net debt to equity, it's one of the key measures we use here at Perennial Value in assessing the financial soundness and strength of individual companies. But isn't it interesting when you go back there to the recession, and many of us will remember that in the early 90s there, how high gearing levels were there, and remember the fallout from that, and then we sort of roll forward to now on the right-hand side and look to where balance sheets are now. Very strong indeed, and a strong balance sheet is the friend of a sustainable dividend. So I think you can very much relate this slide with the previous slide we looked at in terms of the dividend yield there. When you look at it on a company by company basis, the stronger a corporate's balance sheet, the greater the chance of sustaining a dividend yield going forward. So I think there's some quite reassuring messages there in summary when you look at the overall valuation of the overall market. What we'd like to do now is just to turn to the prospects for the Australian economy. And we thought this would be very, very timely. And one of the reasons we thought this would be timely is that, certainly from your perspective at the coalface there, and certainly from your client's point of view, it seems as though, with this 24-hour news cycle, if it's not talking about the Royal Commission on the Banks, it's talking about the political uncertainty down in Canberra. And whilst there are issues, the key message we want to leave you with here is that the prospects for the Australian economy are very, very sound indeed. And so that relates to what we've just talked about in terms of strong corporate balance sheets and the valuations which are available in the stock market at the moment. So we see the Australian stock market right now, particularly in the value space, has been a very, very, if you like, valid place for investors to invest in over the longer term. So what I'll do now, and I just thought it would be worth talking about this because I think we've got some quite reassuring messages here. I'll hand over to Steve to talk a little bit more about this in detail. So Steve, just passing on to you.
Thanks, John, and good afternoon, everybody. So we thought, there's a fair bit of negative commentary around at the moment, so we thought it might be a good time to take a step back and look at the Australian economy and just remind ourselves of just what a strong position we're in. And I think it's fair to say that in fact, the Australian economy, it continues to be the envy of the world. And in fact, some of you may have seen, but The Economist magazine's this month's edition is basically devoted to talking about the Australian economy and its strength. And they go through some of the structural factors that have driven this in 27 years without a recession. And in fact, most of those factors are continuing to this day. So they could be something you might find worth reading. But looking at slide 8 to start off, at the highest level, one of the things that's really been driving the economy is this high level of immigration we've had, and that's something that's been a feature of Australia for for many decades now. And not only is high immigration and a high level of population growth good for driving economic growth, but it's really positively skews your demographics. And what we've got on the right-hand side of the page here are a number of charts put out by the Reserve Bank in a presentation they did a couple of months ago, where it's comparing the demographics of the Australian economy versus the other advanced economies. So the grey line in a way is the spread between best and worst of the developed economies, and Australia's the blue line. So you can see we've got one of the, and as you roll out into the future, we've got one of the lowest median ages. So we've got a young population. We've got a high fertility rate, which will again feed into continuing high population growth. We have a high life expectancy. And then at the bottom right, we can see the old age dependency ratio. We're sort of on the right side of average now, but over time, we're heading right down to the bottom of the pack. And that is a really important driver of economic growth. And that feeds into the fiscal position, which is strong, and with the budget coming back into surplus already. And then the credit rating, the Commonwealth credit rating, one of the few countries today to have a AAA credit rating. And that's all sitting on top of a very sound banking system, which is providing stability to the economy. Now, I know the banking system has had a lot of bad press recently, but from a practical point of view, in terms of its effectiveness, it has to be one of the best systems in the world. Now, as we move on to the growth in the economy is growing at over 3%, a healthy clip of growth. What's driving it? Well, the growth is broad-based in the economy. Housing construction has been a significant contributor to the economy. But when you look, there's this growth across the board. The resource sector is very healthy. Activity's picking up. What we've had is strong commodity prices driving that. We're looking at perhaps even having a second LNG boom as China has entered the market and driving huge demand for LNG. And as I said, housing has been strong and it will be peaking and declining over time. But offsetting that, we've had this massive pickup in infrastructure spending. You see it whether you're walking down the street in the CBD, driving up the highway, or pretty much everywhere things are getting built. And the chart that we have on the right here on slide 9 is taken from CIMIC's results presentation, and it's essentially the pipeline of infrastructure work that's been identified around transport going out over the next 5 years or so. So you can see there's going to be a very high level of activity and employment created in that sector. Then you have the other benefit of a falling Australian dollar. Now that'll obviously benefit any manufacturing exports, but also industries such as tourism, which employs a lot of people, and of course education, which is our third biggest export after iron ore and coal. And all of this, and not to mention it now seems to have started raining, which is going to help the agricultural sector as well. And all this has added up to a very, very low unemployment rate, around 5%, strong jobs growth, and all the lead indicators on that are positive as well. So now moving to slide 10, the housing market is something that obviously is very important and we're all interested in. So turning to that, I mean, our view is that what we're seeing at the moment is a healthy correction in the market after a period of very strong growth. And we'd make 3 or 4 key points. Firstly, prices have been rising very strongly for many years, as we all know. If we look at the chart on the top right there, again, this is RBA data. You can see since 2012, you've had high single to 10% per annum housing price growth. So the decline we're seeing is really coming off a very high level and only taking you back to where you were not very long ago. So prices are still healthy. People are still in the money on their properties. Importantly, mortgage interest rates, which are obviously critical to the housing market, they're low by historical standards, and despite what you might read, aren't really rising. If you look at the chart on the bottom left, it's tracking the standard variable interest rate. If you look in the headline rate is the light blue line, you can see it's still actually ticking down. Then down below it, you can see the rate people are actually paying. The total of all the outstanding loans are averaging around 4.5% and ticking down, and new loans are being written at even lower than that. So we are still in an environment where interest rates are reasonable. And in terms of the supply of credit, it's important that banks are still lending. See, what you can see on the bottom right is that the monthly housing approvals are still running at a healthy 25 billion or so. And you've had that nice pickup in owner-occupier borrowing versus offsetting the decline in investors, which is what everyone really wants deep down. So we think the housing market, we're seeing a healthy correction, and this is actually good for the economy. And when you and then when you think about the housing market, that that obviously the thing that really matters is employment. Yes, everyone has a job so they can pay their mortgages, and demand is good, tying back to that population growth and immigration story. So we're not concerned with the housing market. So that's the economy. We have a fairly positive outlook on the economy overall. So moving on to actually the stocks in the Australian market that you get exposure to on the ASX on slide 11. Now, the interesting thing, I think a lot of people often underappreciate the quality of companies in the Australian market. Now, sure, we don't have Amazons and Googles and exciting things like that, but I think you'd be surprised when you look at it, at the number of genuinely world-leading and highly innovative companies that are listed on the ASX. So I've just mentioned a small number of them here. If we think about Macquarie, for example, it's more than just an investment bank. It's the pioneer and now the global leader in infrastructure investment and asset management, and it's differentiated from other firms who are just pure investors in that it actually has the ability to originate transactions. So it has the capability to go to a blank patch of dirt and build a wind farm, not just to go and buy a wind farm and put it into a fund. So they're a global leader, they're differentiated, and they're really strong in the renewable sector. And when you read the statistics on the potential growth in that part of the market, it's almost mind-boggling. So again, an Australian company taking it to the world and being a leader. Lendlease, another one. Now, most of us in Australia, we just think of Lendlease as somebody who builds apartments, and well, the apartment market's slowing down, so that's not exciting. But the reality of Lendlease is it's far more than that. It's actually one of the handful of global leading companies in doing these large-scale urban renewal projects. These are 10-year projects where they'll partner with a local government and redevelop a whole swathe, a whole part of a suburb, for example. And these are very capital efficient, long-term projects for them. And the other thing that's often missed in Lendlease is around 40% of its earnings come from its property funds management business, where it has excellent relationships with the sovereign funds who invest in this part of the market. So again, an Australian company that's doing great things on the world stage. And then finally, Amcor. I mean, packaging is not a very sexy business, but Amcor is the global leader in flexible packaging. And when you actually walk through the supermarket and look at the actual intricacy and the technology and some of the packaging of the things you're buying, you realise if you look at it, there is quite a lot of innovation there, and at their scale, they can work with the big FMCG companies and the big retailers to pursue things like having 100% recyclability of all packaging by 2025. So that's just a flavour of some of the companies you get exposure to in the Australian market. So moving on to slide 12, resources. They're definitely worth mentioning. Now, mining's hardly a new economy sort of activity, but I think it's important not to overlook the fact that mining is a highly technical and highly sophisticated activity, and our big miners, BHP and Rio, are absolute world leaders at this. We have robotic trains, driverless trucks, etc. Data analytics driving the whole process. These guys are at the cutting edge, most advanced, lowest cost operators globally. And when you look at the valuations they're trading on, low double-digit multiples of cash flow, attractive dividend yields, and very, very strong balance sheets. So we see, world-leading businesses in a supportive supply and demand environment, which are going to be returning a lot of capital to shareholders over coming years. And then finally, moving on to the banks. Now, we touched on the banks earlier on. On slide 13, the banks, of course, have had a lot of deserved bad press in recent times, but when you step back and look at the fundamentals, it is a highly functional system that's been very good for Australia for a long time. And when we think about where the banks are today, we think even though the growth outlook is really quite subdued, the relative valuations are attractive, the capital positions are strong, the funding and liquidity bases are strong, and on the back of this healthy economy that we've got, the credit environment is very benign. So we think as sentiment improves, as the Royal Commission passes, there'll be renewed interest in the banks. So with that, I will hand back to John.
Thanks, Steve. So I hope there's some quite reassuring messages there just on the overall economy, and so just getting back to the key theme of where we see the opportunity in terms of shifting gears to value, page overhead number 14 there. What we've done here is that we've just, in the green there, we've just given you, and we've already talked about some of these stocks. Of course, there's just a bit of a snapshot of some of the stocks in the portfolio. The forecast 3-year earnings per share growth, the PE, and the gross yield. And then in red, at the bottom half of that table, we've already touched on CSL, but some of the stocks that we're not holding. I think that the first point to make here is really quite interesting once you start to look at this on a sort of a stock-by-stock basis is in terms of the 3-year earnings per share growth, these are based on the forecast which our team of analysts do here at Perennial Value. The companies in the green there are sound earnings growth prospects over the medium term. You can see there that small snapshot of companies, which is not untypical of the overall portfolio, around about 10% per annum. Then you drop down to and I think the more surprising number is the one down the bottom there for the red companies, the average year of 12%. Now, one might have thought intuitively, given the massive growth rates of these companies in the past, that earnings per share growth forecast going forward, annualised for the next 3 years, might be somewhat higher. But in fact, it's not. In fact, you can see there's not that much difference. So when these companies were, I guess, were a fair bit smaller, they could grow a lot quicker. But they're now very big companies. What gets more interesting in the context of that, therefore, is the the valuation differential between these two groups of stocks. And you can see there the average price to earnings ratio of that small snapshot of stocks there, and also the gross yield there of 5.9%. And then you contrast that down the bottom right-hand side there with the, picking up the earlier theme there, this group of stocks trading on 30 times. Paltry yield, very paltry yield there of 2.2%, not paying you much in the way of dividend yield along the way. And then you can see in the middle there the Perennial Value, the portfolio there, overall portfolio 13.9 times and a gross yield of 6.2%. So, a group of stocks there offering very good value indeed. But there are a couple of other points I would highlight here, and that is, the two components of total return. Companies that grow their profits over time should do two things, ideally, in our view. Number one, deliver a tax-effective dividend income stream, but secondly, their share prices should grow up over time, and that should give capital growth as well. So it's a bit of an each-way bet, and this is one of the things we like about the sort of stocks we've always invested in, that each-way bet of both dividend yields, tax-effective, and also capital growth. And that gives us some margin for safety as well. And that margin for safety, I know, is something you've heard many of you have heard me talk about before. You don't get that margin for safety in a group of stocks trading on a PE of 30 times if something goes wrong, and certainly not underpinned by that paltry yield. Probably the final point to make is that, the last few years have been frustrating the value investors' point of view, not least ourselves. But we've certainly stayed true to label because we certainly believe that these are sort of stocks that deliver over time. Then turning to page 15, what we wanted to do is just give you a bit of a sense as to portfolio positioning and key themes at the moment. We've already covered a few of these themes, so I won't go through them all in detail, but just a couple of other things to add to what Steve and I have already talked about. Mining services there. That's a sort of a theme that we've just added, folks, to the portfolio over the last 2 or 3 months. You'll see on the previous page there, we talked about Ausdrill up the top there, mining services company, good business, good value, others like Monadelphous and so forth. So what's interesting about that is sort of tapping into a bit of a theme there. The theme is that we know that global mining companies and energy companies, they've really underinvested in terms of greenfields and brownfields projects for a number of years now. They've really concentrated on giving cash back to shareholders. We all know with mining and energy companies, every day they dig something out of the ground or pull something out of the ground, their resources do deplete. So at some stage, inevitably, they've got to start reinvesting back into that. That is now starting to happen after a very long period of it not happening. And we think that over the medium term, that will benefit mining services companies. Tourism and leisure, just moving towards the right-hand side of the page there, Event Holdings, the old Amalgamated Holdings, core holding in the portfolio for many years. Hotel exposure there, Rydges Hotel Chain, Atura, QT, Greater Union Theatres, on the leisure side as well, and of course the Star and Tabcorp. And picking up Steve's earlier comment on infrastructure investment as well, good exposure there, not just to domestic infrastructure, but to global infrastructure as well. via Lendlease, Boral and Macquarie. So I think in summary, I do very much see this, particularly now, given these changes that are occurring in the markets and this rotation from growth to value. I really do see this as a fund for all seasons. And I said very much as a core holding. You know, it's full of companies with strong balance sheets, sound medium-term growth prospects, and a significant margin of safety from a valuation perspective. Which brings me to the conclusion. You heard Steve there talk about the Australian economic outlook. We think it's very sound and positive over the medium term, and hopefully Steve gave you some very strong reassurance that's the case. Certainly, the rest of the world, whether you look at the recent Economist article or a recent OECD study, we're very much the envy of the world. And I think in the context of all the bad news that we're getting on this 24/7 news cycle at the moment, I think we thought it was worthwhile just sort of reiterating that. And I think, therefore, that should be good news for investors in the stock market in Australia over the longer term, with the hot air now having come out of the market over the last we said the stock market is fair value overall, certainly on a yield basis, and certainly when you look at the strength of corporate balance sheets in Australia, we think there are compelling reasons to be invested in the stock market at this point in time. Momentum growth stocks, we spent a fair bit of time talking about that, remain overvalued, significant de-rating risk there. 20-25%, it depends on what stock you look at. But what we do know there is that sometimes these things can overshoot, can't they, as well? So the downside could be even further than that. Who knows? Many good value opportunities exist in quality companies with sound prospects. And so I think in conclusion, we do think it's time to shift gear from momentum to value investing. We do see calendar 2018 as representing a turning point. We talked about the number one, the macro headwinds now appearing for growth and momentum. But I think just as importantly, the valuation differentials, and we spent a fair bit of time talking about that today, excuse me, very much in favour of value stocks. So I think from a financial planning perspective there, and I know many of you are sort of a value bias anyway, which I hopefully these are reassuring messages, but perhaps for those clients that aren't, we do think it's a time to be thinking about perhaps a rebalance, if you like, selling high, buying low, and making that switch. If that momentum in that trade that we're talking about picks up, you don't want to be running through the door at the same time as everyone else, as we all know. But I think finally, and to this point, we've always believed that perennial value, that buying good businesses for good value makes sense. Over the long term, it is those companies that will steadily grow profits. And the great thing about that is that companies that steadily grow profits, they deliver that each way exposure, which I talked about before. They deliver both a rising tax-effective income stream, so you're getting paid while you wait, but also deliver capital growth via a rising share price over time as well. So I think we've sort of largely finished on time there, and we have some questions there, and perhaps we can just bear with me. We're just scrolling through the questions there. There was one question there on just one question on microcaps. What's a long-term target there on microcaps over 10 years? Andrew Smith, who's the manager of microcaps, has a personal target of 20% per annum. That's just a target. I think with microcaps, certainly that's a target which he has over the medium term, and microcaps obviously far greater earnings growth prospects there. I'm just looking through the questions there. Is there a question there on mid caps there? That's value. It keeps going down there, so let's see. There was a question there about there's a question there about perennial value, staying true to label there, and not having kept up with markets over the last few years, which I think is valid in some ways. What I would say to that, and I acknowledge that we have underperformed over the last sort of 5 or so years, and on the back of this growth momentum trade, it has been unprecedented. A number of value managers have been in the same camp there. I know the likes of Perpetual and Maple Brown Abbott are in that camp as well, and certainly globally, that's been a key issue as well. But I would reiterate, I think a couple of points there. We've had the courage of our convictions to stick with what we believe works well. As I said in my closing comments there, our fundamental belief is that share prices should, over the longer term, follow companies' profits. And what we've seen with this easy money trade, which I think is now coming to an end over a number of years now, is this decoupling of share prices, whereby they've risen much higher than earnings growth. I think that game's now over. So I think selective stock picking, prudent stock picking now is now starting to re-emerge. There was another question there on the, and I should say too, we're just going through some of the questions here. We mightn't have time to get through them all, but we can certainly come back to the individuals if we don't pick up questions. I should have mentioned that in the introduction. There was just a question there of Steve, just on the housing market there, just in terms of the influence of that on the economy. But I think the summary there, Steve, is that there are there's some uncertainty there, but I don't think we think that. Do you want to just touch on that and just perhaps balance that with some of the more positive things?
Yeah, I mean, I think in terms of the housing market, there are two things that matters, which drive your ability to service your loan, and that's, do you have a job and what are interest rates? And when we look at the current employment situation and the likely outlook for inflation, and then couple that with what interest rates are at the moment, and the likely trajectory with inflation being under control, we don't see a situation where you're going to have either significant unemployment or excessively high interest rates. And one of the thing that's been very interesting in the whole credit discussion is that people have been concerned about the outworkings of the Royal Commission, but it's important to note that banks have been progressively tightening, under APRA's instructions, progressively tightening lending standards for nearly 3 years now. And when you listen to people speak, be it APRA, be it the RBA, be it Treasury, be it even the Deputy, the Shadow Treasurer, everybody is at absolute pains to stress that they do not want to do anything which is going to impede the flow of credit and support for the housing market. So I think the fundamentals are there, and then as I said before, you do have this strong underlying demand. So the downturn we're seeing in housing shouldn't be anything of excessive concern.
You scroll down there, sorry, just on that question. There was another question here related to the Australian outlook is positive for accumulating clients. How is it for clients on pension phase, where they need to draw on their capital? How long do we expect this correction to last? Steve, you want to talk to that?
I suppose obviously it's impossible to know how long a correction will last or how deep it would be, other than though we would point out that where we see the corporate earnings outlook, as we talked to before, as being reasonably healthy, and then the multiple that the market is now putting on that earnings is around the long-term average. So in a way, you could argue that the market, in average from here, you shouldn't expect there to necessarily be much more downside. But who knows? Obviously, though, from a client in a retirement point of view, and I think this is where the dividends become important. One of the one of the key features of the Australian market and the way we run our portfolios in particular is with this emphasis on gross dividend yield. Now, the dividends in the Australian market are attractive. The market's paying a bit over a 6% pre-tax dividend yield. Our portfolios will pay a bit of a higher underlying yield than that. And given the strength of corporate balance sheets, those sort of dividend yields are sustainable. So for investors in retirement phase who are focusing on the dividend income, I think the outlook is reasonable. And what we've seen in the previous downturns is that share price moves are far more significant than the actual moves in dividend income. So your moves in dividend income in the GFC, for example, were less than half the moves in the share price. So investors, who are in retirement phase and living off dividends, for example, have sort of a lot less to be worried about in that respect.
A question here, Steve, on the you've been the banking analyst for a while. You talked about the banks, but there's a question here on on our positioning at the moment in the portfolio itself.
Yeah, we have around I think about 23% of the portfolio in the banks, which is pretty close to the overall index weight. And as I said, we think from a fundamental point of view, the banks are solid. The sentiment is obviously very negative at the moment. We think that will persist for a period, or as the Royal Commission washes through, and until people become comfortable with the housing market. So hence we don't have a strong overweight position in the sector. But within the context of a market where there are expensive bets, for example, I would rather be holding a bank than holding CSL, where there's significant downside derating risk. The banks, you've got a positive re-rating to an extent, but looking at them, I mean, the forecast that we have, which is sort of similar to consensus over the next couple of years, is for very modest earnings per share growth. But if you put some modest earnings per share growth on top of an appropriate multiple, which we think they're trading at, and then add on nearly a 10% dividend yield, which we think is pretty close to sustainable, then your actual total return outcome from the sector could be quite good.
There's a question there related to Perennial Value's performance related to other value investors. We've been ahead of some, and we've been behind some. Probably the only observation I'd make there is that we've all got different styles of value investing. And I think one of the things you've always found with us is that we've stuck to what we believe works well over the longer term. One of the things we've observed over the last few years is, and it's sort of come from talking to people who've been in the markets for a while, is that the style drift. When things are out of favour, sometimes you can sort of drift away from what you passionately believe in, and I think there's been a bit of style drift in the Aussie market. And there's definitely been style drift also in overseas markets. So I think when not all, there's no doubt about it. Having observed value managers over the years, you're not always comparing apples to apples. I think in the Aussie market, there's quite a range of value investors. Some are more on the sort of more towards the growthy end, if you like. Some are more back towards the value end, which is probably more ourselves. So it's a little bit, I think it sort of makes it a little bit difficult to compare, because you're not always comparing apples to apples from time to time. There's another question there just on imputation, and just talking about the tax effective yield of the Aussie market going forward, and any potential implications from a Labor government getting into power and potential changes there. I'd make we can both answer, but I'd probably start off by saying I think there was a really, really interesting insight in the Wentworth by-election where the Labor Party vote actually declined. And I just can't help but think there might have been a pretty strong message in there, amongst other things, not to tamper too much with the dividend imputation system, and not to tamper too much with capital gains and so forth on property, which I think is probably quite insightful from a Labor's point of view. I think also too Chris Bowen, who'd be most likely to be the Treasurer if Labor did get in, and I think it's far from a fait accompli that Labor would get in in any case, that he's a disciple of Paul Keating, of course, was the father of the superannuation and dividend imputation system in Australia. And I think Chris Bowen's more on the moderate side, if you like, as opposed to being more towards the left of some of his peers in power there. But Steve, any other comments to make there? So
yeah, I mean, the proposals as they currently stand are really inequitable, depending on what sort of structure you're in. So, as John said, Labor have got to get elected, then they've got to get it through the minor parties. So there's probably, I think, a fair bit of water under the bridge, and what will come, if anything, will probably be quite different to how it's pitched today.
Probably one final point there, just reflecting on underperformance of value and so forth. One of the with the significant changes we have made over the course of this year is that a number of you will have seen that we brought in a chap by the name of Andrew King. Andrew King is a mid-cap specialist in the Australian market. He's been playing Australian mid-cap for many years. We've known Andrew for many years as well. Andrew cut his teeth with IML, Investors Mutual, and also with Paradise Investments. So very strong value pedigree there. So Andrew joined us earlier this year, and what we have now is Andrew managing 20% of the portfolio. So that's something new which we've introduced into the portfolio this year, and when in fact it's been in the second half of this year, so it's very early days. We're actually quite excited about that because he brings a slightly different way of looking at value. So that just gives us a little bit more flexibility, which I think is a good thing in terms of that mid-cap area of the market. So early days, but certainly the reason we brought him on was that he's a very fine pedigree in terms of a value investor. Whilst we've always had exposure to mid-cap stocks, as you know, this has enabled us to increase our exposure there, and we think that's going to be a stronger point in terms of the portfolio mix. Earlier in the presentation there, I talked about the introduction of the mining services companies by way of example. They're down in that sort of high, mid-cap area, if you like. So I probably should have mentioned that earlier in the presentation, but we certainly see that as a positive as well. Now it's just hit 12:35 and on our time at least. So I think we're bang on time there. Thanks very much everyone for your attention and for attending. It was much appreciated. Hopefully you got something out of that. Hopefully we were able to address as many questions as we can. And if there are any other questions remaining outstanding there, we'll just scroll through them and certainly come back to you. But thanks again. And
thank you, everybody.
And we look forward to being in touch. As I say, we'll be sending this material out to you. Okay, thank you, folks, and have a good day.